Long-term patience wins. 2. The toolkit. How to find undervalued opportunities.
Okay, so if the foundation is this mindset shift, focus on the business, be patient, the next big question is, how do we actually find these opportunities? What's in the toolkit?
Right. This is where fundamental analysis comes in. It's not guesswork. It's like being a financial detective digging into the company's health.
Okay, where do we start digging?
You absolutely have to start by decoding the financial statements. They're the language of business, really. Standardized ways to see what's going on.
Makes sense. Let's start with the income statement. That's like the report card, right? Shows revenues, costs, profit over a period.
Exactly. Quarterly or annually, usually. Shows revenues, expenses, and that bottom line, net profit or loss. Most people fixate on that net income number.
But there's a catch.
Big catch. Be careful, that net income figure. It can sometimes be, let's say, managed or heavily influenced by one-off things, like selling a big asset or taking a big restructuring charge.
So it doesn't reflect the core, ongoing business health necessarily.
Not always, no. You need to look deeper than just that one number, understand how they got there.
Okay, then the balance sheet. That's different. It's a snapshot in time.
Precisely. It shows what the company owns, assets, what it owes, liabilities, and its net worth equity at one specific moment. It tells you about its financial position, its solidity.
Or fragility.
Or fragility, indeed. And interestingly, Jerome Boss, we mentioned him, he actually likes to start his analysis with the balance sheet before the income statement.
Why is that?
He argues earnings can be easily manipulated. They're more volatile, less reliable for true worth. The balance sheet, he feels, is more grounded, gives a more solid starting point, less subjective.
Interesting take. Okay, and the third one, the cash flow statement. You said this is critical.
Absolutely critical, in my view. This shows the actual cash moving in and out. It details cash from operations, from investing activities like buying equipment, and from financing like debt or issuing stock.
And the key is it's harder to fudge the cash.
Much harder. It's less prone to accounting games than net income. It gives a truer picture of the company's liquidity, its ability to pay its bills, its real underlying health. Cash is king, as they say.
Got it. So statements first, then we use ratios to make sense of them quickly.
Exactly. Ratios help us compare and assess valuation and health. First up, the classic, price to earnings or PE ratio.
Share price divided by earnings per share. Everyone knows this one.
Right. And while a lower PE can signal undervaluation, what counts as low really depends.
On the market, the industry.
Exactly. Maybe below 15 is low in some markets, but in others, maybe below 10 or even below 20 could be low depending on growth. You have to look at the context compared to competitors. And by the way, a PE ratio that's shooting up, that can be a sell signal. Might mean it's getting overvalued.
So it's not just the number, it's the